Right. I think I was in the wrong room. Yeah, somehow we booked this twice, so I appreciate you guys being in the right room because I was in the other room waiting, and you know what? I felt very lonely, so I'm glad to see many of you here. So thank you so much for joining us. Um, this is awesome. Good to see you. Let me make sure that yeah, I know. Seriously. I was like, well, I guess nobody wants to talk to me. Chris, let me bring you into the panelist. And if anyone else wants to come into the panelist room, just raise your hand. You can ask questions, you can interact. I think my internet is skippy, so I apologize if I'm just frozen at any given time. So welcome everybody. Let me make sure that the Q&A is open. 'Cause some of you are shy. Yeah, I used to be shy. And then I wanted to make money, so I was like, I can't be shy if I want to make money, especially in the real estate. So welcome everybody. Let me see. Mm, Very nice. Okay. Yeah, my internet is a little skippy, so I will make sure that if you don't, but I think my camera just went off. Chris, oh, can
It
you see
sure did, but luckily I'm here just in time.
me?
So if you pop out, I'll pop in. How does that sound?
Awesome.
Um, Give me just another second here. I'm going to plug in my computer because I used it earlier for a couple of calls, and so I want to make sure the battery lasts.
No problem.
You're
So
good.
yeah, so go ahead.
Nope, you're fine.
Okay.
You can go ahead and
All right.
start.
Awesome. So I'm gonna so this afternoon somehow, with your iPhone you get memory pictures, some the a year ago or whatever many years ago. And one picture came up. I was traveling solo. I was actually in a military mission in Sicily. And I took this picture, just very beautiful streets, cobblestone, narrow, like it's like tiny little cars can fit in there. And it's just beautiful. Like it just like I just wanted to capture that like everything. And of course it was a selfie, so I was there. And so anyway, I was reminiscing on like the beginning of my real estate career because I remember that trip. Like I said, I was on orders there, so it was a military assignment. But I had at that point I had three apartments, and I was under contract for eight more. And it was so terrifying to be away, not only away from like the city, but the state, away from the country, and thinking, I hope the systems that I put in place are good enough. I hope nobody calls me, with the time difference. It would have been, if they call in the middle of the night, that would have been perfect for me. But there's this type of situations in your career and the journey of the real estate that sometimes you build the confidence and you have systems in place, but then there's a point where you need to test them, and that was a moment where I was just super nervous. I was like, did I do this? Did I complete this? Do I have enough money to pay all the bills? And it's moments like that kind of shake you. And there's a book that if you haven't read yet, of course I forgot, the delegation book that is like 2 hours. Listen, Chris, the
4 hour work week.
that's one, but there's I will look it up. But it's like how you put systems in place, and the best way to test them is to go away, like even like if you have a team. If you have a team and you want them to have standard operating procedures or protocols to how to handle a situation, and you want to know if that works, if they have everything covered, just send them on a vacation. And who doesn't like to take vacations, right? But that's a really good way for you to find out what holes are in your systems and then come back and fix them or fix them as you go. And the reason why I wanted to start with that with that specific story is because in the real estate, you must have the discipline that gives you the comfort. And if you're raising money from investors, it gives your investors the comfort, feel confident that the numbers are up to speed, that you can report to lenders, you can report to investors. Like everything has to be so like organized, and the way Chris and I, because we work together so much, the way we make sure that if he wasn't here for whatever reason, or if I wasn't here for whatever reason tomorrow or today, that somebody in the team, in our team, or himself has access to all of that information. So we're building an in-house chat GPT like database, so it feeds from all of our OMs, all of our KPI reports from our properties. Everything is linked. So like if I have a question and I don't remember, like, hey, when do we buy this property? And then it can give me a little bit of who the partners are. So it integrates all of that. Again, if you're a person in the business and the real estate business that are still collecting your rents, by money order or even cash, or if you're still the one picking up the payment and you have no systems in place, there is actually a value, if you were to find a portfolio like that. That's the value add that you can bring in. Anyway, let me make sure that I have, let's see, and yeah, put your questions here if you are.
I just dropped some stuff in the chat that are options for the book that you're thinking of.
Okay, thank you. All right, let's see. All right, I know, I see somebody here. There you go. I saw somebody here that wanted to talk about, how to get started, as far as how do I get started as investing. This is a new business for them. I think that a lot of people might have some questions that are similar, so I will definitely address them. And Raul, I sent you an invite so you can come into the panel since you raised your hand. If you didn't mean to raise your hand, then just ignore it. But if you want to come to the panelist room, we'll love to have you. And here you are. You're muted.
Sorry, I couldn't figure it out. I didn't know what you meant by enter the panel room.
Well, here you are. This is it. Bye. Just kidding.
All right. Okay.
Just kidding. No, just kidding.
Welcome.
Yeah.
So yeah, the panelist room, sometimes people want to ask questions that are more extensive, maybe explain the context so we can, elaborate. Or did if we're talking about something, a topic that you might want to, give your opinion or your intake, that's why. But you're here. Do you have a question, or do you have a
No,
property
what it
you're
was,
pursuing?
he said the chat was disabled. I'm like, well, the chat's disabled. They can't see me. They can't hear me. I'm like, I don't know how I'm going to get through this.
The
And
the
look at
Q
you.
and A, the
All
Q and A
right.
is the easiest way for us, because if
Okay.
people start chatting in there, then we lose track of the questions. So the
Okay.
Q and A is the easy way to drop in questions if you didn't want to ask it in person, but you're here.
Right.
Like she
Okay.
said, if you have one, feel free.
Mhm.
Okay, no, actually, I attended one of your events. It was a couple months ago, but I've been busy underwriting so forth. But I had a deal that I wanted to try to get a key principal for and some partners, and I'm probably going to be presenting it at the next Pitch Your Deal on Wednesday.
Nice. I think
So
on Wednesday you actually mentioned it for a few minutes, either Wednesday or Friday.
it was
Is it the
Friday.
same deal? Yeah,
Yeah,
same
but
deal.
it got a
Okay.
little chaotic on Friday because, I started with Andres and then he kind of disconnected there. And then Grant jumped on
Grant
there
showed
and
it.
he
Sure.
talked about that show he's doing. I'm like,
Yeah. Yeah.
so
No,
anyway,
that's good though.
that's why I'm here. So I can be part of a group that will be able to assist me and I can find out how it all works.
Very
Awesome.
nice,
Yeah.
nice. Now, yeah, I hear briefly. I think it's at 80 units, and yet again, you don't have to
Yeah.
say answer, but
Right.
no, that's exciting. Yeah,
Yeah.
that's exciting. I'm here in Houston. We are wrapping up the CapEx project for the 34 unit that we purchased. And, like once that you get to certain hubs and, milestones of the deal, you're like, okay, what's next? And I was looking around for some deals, and I didn't tell Chris because this was this afternoon, but I found I think it's a 40 unit here, like 18 minutes from this place. And again, and in our case, because this is too small, well, small, if we can pair up another, 40 or so, then you start building the systems, and then, you fine tune the operations, and, like we made so many contacts with contractors. We had really good price negotiated. So I'm like, okay,
Mhm.
what is next? And then I found a 24 pad mobile home park. We have five no, four mobile home parks. One of them where it's refinancing, and another one is under well, we accepted an LOI to sell. So, we're it's fun to be the hunter, to go there and look for deals, and, just keep that exercise, keep the muscle exercising, that's how you get
Right,
stronger.
right.
Um,
Well,
okay. Well, do you want to stay here? Do you want to, you're welcome
oh,
to.
I'll just get back in the background and just waiting for you, you guys to proceed.
Well, like we said, just click the question Q&A button and put in your question, and we'll answer it when it comes up.
Okay, thank you.
Absolutely.
Good seeing you.
Good seeing you.
Yeah. Congrats.
Uh,
Yeah.
yeah, yeah. All right. So let me make sure I okay. Perfect. So, yeah, as you can see, this is a very open conversation. We talked about what we're doing, what are we looking for as far as deals, other deals that maybe we went for and it didn't solidify. We share those lessons learned. But since that specific question came about, how do I get started? What can I do to add to the team? Um, maybe this is your first GP, and a lot of you, for what I see, some of you I know you like in person, and some of you are already invested with us, so thank you. And it's good to see how you progress from like being thoughtful in the numbers or the pitch, or just like think information goes over your head, and it's good to keep coming back, because the things that we talked about, we've been talking for like 5 years. This is a meeting that we've been doing. Well, this one is probably about a year and a half. But we have a virtual meetup, which is actually this coming Thursday, every third Thursday of the month. And we've been sharing the same information for 5 years. But guess what? So it either the first time where you hear it, it wasn't like clicking, or you weren't there, like you were thinking of something else, maybe growing your cash flow, maybe your business, who knows. So repetition solidifies. Repetition is going to build the confidence. And in this business, you have to have confidence. If you don't have it, you have to borrow it from somebody else that has it, so you can team up with them. And that's what the GP and co-GP means. For example, if you have a deal, um, what you don't have the confidence. You never raised money. Maybe you have some money on your own. Maybe you know some people, but it takes the confidence, because even if you have the most amazing deal, you go and present it to somebody, and the first time you're like all over the place, and they ask you questions, and you're like, oh, well, hold on. And then you start doubting yourself, the numbers, and they start that, like, that's contagious. Imagine you going to the doctor, and when you ask a question to the doctor, or they're looking at the x-rays, or the analysis study results, and all of a sudden you're like, well, what's wrong with me, doctor? And they're like, well, hold on, I'm gonna have to go. The confidence just like blooms, and then you're like, I'm going somewhere else if I want to stay alive. So that's exactly what happens when you don't have the confidence. So it doesn't, I mean, it takes repetition, and it takes doing it. It takes putting your money to work, so you can see how that money is moving along the timeline of the investment. And when you see the full cycle, hopefully before you can feel comfortable and confident, so that you can go and talk to others about real estate. But definitely when you go full cycle, when you invest your money and you see the progression, you see the business execution, business plan executed, and then you see the results and you profit from it, you're like, oh my gosh, this is it. I'm gonna do this over again. And then you start falling in love with different markets, different assets, different teams, and that's fun. That is a lot of fun. So for those of you that are like, well, I don't know where to start, maybe you hear some people asking for like a KP. You're like, I don't know what a KP is, but that's where you need to keep coming here, ask questions, ask a lot of questions. I think that average probably 5% of what I say or what Chris said is going to stick in the first time. And not because you don't get it, not because you whatever. It is because it's new. If I was to learn another language, hold on, let me write things down. Well, that's the way, that's the level that you need to be at involved. You can't just be listening on this and be like on the go, being distracted, being called, paying for your credit card, the credit card fail. There's so much distraction. If you're serious about being in this business, you must commit some time. Okay. So, and you need to ask questions. What we do here, it's free. Everything is free. The information that we share here is not free. We pay for the information. We paid for to get to this level. We have been doing presentations for years to get to this level of just randomly talking. It takes some skills. But I love to hear your questions and how can we get you to be a part of our team. Um, and what we have is we have what we call it fluid teams, meaning that Chris and I are always going to be on the team. However, um, maybe we have, I don't have names here, but like let's say that we have um, 3 or 4 partners that are in this deal, and then they are going to be busy. I guarantee you, if they're going to be hands-on, they're going to be busy. Well, guess what? Maybe in the next one, they're just not going to be as involved. Therefore, we're going to need new partners, more partners. Some partners we have, I mean, some deals we have partnered with, 3, 4 deals the max, I think. In the roles that these partners take are a little different. Maybe the first one they were like, let me just, I want to be in the room. I want to have those meetings with you with the property management. I want to see the flow. And then the second deal, like, okay, I can help you with investor reports. Well, now I can help you with keeping KPIs. And then slowly they start getting more and more into their hands. So, and it doesn't have to be that you have to quit your job and come and be a full-time real estate investor or sponsor. Most of our partners have other businesses, have other jobs, have families, travel. Same thing for us. The reason why we bring new partners is because we don't want to do it all by ourselves. It really it's a lot of work, a lot of responsibility, and we like to have some kind of fun and balance in our lives. So at this point, we're at the level, I guess, or in the position where we can sponsor a deal and we bring co-GPs so that we can close the deal. So whether you have the deal and then you want us to come along and do the structuring the deal, calculating and explaining the investor returns, talking to the lender, talking to the lawyer, we can help you with all of that. Maybe you don't have a deal and you're like, well, I know a handful of people that can invest with me. Well, then you're gonna be helping with bringing investors. But um, or maybe you're boots on the ground. And let's suppose that you're in Houston. We just bought a deal in Houston, and one of our partners, she is boots on the ground. She lives like minutes from here. So, we stabilize the project, we do like the heavy lifting, and then she stays because she lives here. We don't have to travel all the time, and that's very valuable. So if you're in a market that it's a good market, it's the definition of a good market for us is a growing market or a cash flowing where you can find a cash flowing asset. We are very focused in Texas and we'll call the smiley effect states or the Sun Belt states, and pretty much is the same as business friendly. So if you're in one of those locations and we even if we don't have any properties there, but you can commit to being available to help with the project, we can definitely consider that as well. Um, Ideally, everybody in the team is invested in the deal, whether it's from your own capital, the or the earnings from the getting that into the deal. And every deal is different. Some deals are small, some deals are bigger. The way you contribute and get equity is calculated, and we have I won't say complicated, but very objective way of dividing the equity. And if you are in one of our teams, then all of that is disclosed to you. It's a little complicated to talk about pretend deals, so it's hard to do it. But the concepts that I told you, the things that we need from partners, is how you get equity. So let's suppose that you found the deal, and you can also you happen to be living right within an hour drive or shorter, commute. And you happen to have investors. So all of a sudden, your equity percentage is going to start growing because you can do more for the deal. Does that make sense? I think I see some questions here. How do you vet partners and what do you look for? That's a great question. Um, so that's a great question because let's say there's different like I said, what we look for is, can you raise capital? Do you have the net worth to sign on the loan? Do you have the time? Are you in a location that is desirable for the deal? And then are you looking to do active asset management, and do you have any experience that is transferable to managing an asset? So we look for those things. So I know that your profession is very desirable, the person that asked the question, and you probably have access to some investors, and you also are very knowledgeable in the numbers. So that's something that it's a lot of value. How do we vet them? If you're going to be signing on the loan, the lender is going to be doing a background check for to clear make sure that you have no loans that are in bad what do you call bad you're muted
In bad standing.
investing. Or that do you have something that makes them believe that you are a risky person to be on the loan. So and the other, like, if this is your first deal, we want to make sure that we have a very open and early communicate conversation with you to understand what are you looking to, what can you bring to the table. So the same um, topics that I cover is going to be the source of questions. What can you do for this deal? And then the last thing is, if you already are in some deals, we definitely want to know what is your role in those deals. How are those deals doing? We pretty much want you to pitch your deals to us, and yeah, what's your commitment to them? And pretty much that your deals are not going to impact the way that you can serve this new deal. And we have so yeah, so I think that I answered the question. Let me see. Are you typing something?
No,
Would you explain how, why, what the bank debt yield is? Is this for lending?
yeah.
Yeah. Right. So to keep the conversation organized, let me just read the next one, if that's okay. Um, okay, can you tell us about the multifamily property that you took full cycle? What were the financial results and how did it compare to the initial numbers? That's a really good question for Chris. How can you ensure integrity and compatibility of the partners? That's another great question. So most people that we partner with, we probably been in conversations for a while. We want to make sure we break bread. with you and your family. We want to make sure that we align on how we want to treat our residents. How do we want to, do business with other what do you call the vendors? How do we want to deal with you know managing the property. We want to make sure that we are aligned in that direction. So we do sit down, we meet, we want to definitely be an in-person meeting. And it takes some time to get to know each other at that level. Financially, like I said, the lenders will do a lot of the background due diligence. And if we have we have had partnerships that have gone wrong, and we have learned a lot from those partnerships. A lot of it has to do with us being wanted to be so involved. Like, we want to be at the heart of the operations. We want to know financials. We want to be able to talk to the investors, talk to the lenders, talk to that, be in the heart of the operations. We never want to be the ones that just sign on the loan and then just forget about the deal, or never visit the property. So if you're not, and in some of our partners, to be transparent, are very what I call a passive, even though they're general partners. Once that their phase of their contribution is completed, they're pretty passive. And we do have that agreement. I have physicians that are like, I am not going to come to the property and do this and that. That's understandable. So we have that conversations up front. Now, we have had some very enthusiastic partners that are like, well, I'm gonna help you with this and I'm gonna help you with that, and then they get trained on it, and then like 2, 3 months later, they're like late, and then they just disappear. So we have learned to do that. I mean, to have those conversations up front, and also to be able to adjust the not the compensation, but the equity as well. And we do have a schedule, like we have meetings that evaluates the performance not only of our partners but ourselves as well. Hey, what are we doing that might need changing? What can we improve, even in our process and ourselves? So it is an ongoing game of dating, but definitely you want to do a lot of dating before you get into this financial marriage. Let's see. I think the other questions are for lending and returns. The ones that I wanted to talk to with because he asked specifically multifamily, and I didn't specify. We've done multifamily as passive. We have done self-storage facilities as GPs, and trying to think, in mobile home parks. We're
Also,
I guess yeah.
okay. So I guess it's my turn, because
Mhm.
we're going to talk lending and deals, right? In a different capacity. So I hope the question's still up there, because I want to re-hit it here. Let's see. The property that you took full cycle. So the multifamily property that we took full cycle, we owned ourselves. It was an 8 unit. We paid 140 for the 8 units. I think we put somewhere around 84 to 90 into it. And then we sold it for 284. So we made a little bit of money, but we only owned that thing for maybe 3 years. I don't even think it was that long. Plus we had the cash flow on it. I could not tell you the true numbers. We never really went back and recalculated that on our personal stuff. But we do have a storage that we owned it for 4 years. Actually, it was 4 years and 3 months, I believe it was. And for that one, we brought our multifamily experience. We brought our systems and concepts into the GP, actually, it was a joint venture, not a GP LP split, but it was a joint venture. And for that one, the money that was invested in there, we got a 3.1x return on our money. In 4 years on storage, which is not very common. Usually it's a 2x in 5 years, just like multifamily. But we bought it at a good time. We sold it at a good time. And I'll be honest with you, had we sold sooner when the market was still a little bit better, we could have like really crushed it. That's what I'm going to say. Really crushed it. And 3.1 in 4 years is still not bad, right? That's um, what we end up with? We ended up with, in 4 years, we ended up with a 50% annualized return, right? Out of that, that's what a, um, 3x multiplier would be in 4 years. So, that's a quick breakdown, but like I said, we brought these pieces of history, experience, and ability into the team that others couldn't do or had never done, right? They never worked it. We were not, it was our very first storage. We were not experts in that area, but they were supposedly the experts for storage and finding the deals. One of them was really good at finding deals. The other one had already done multiple deals. So he was kind of the senior person with experience. And we utilize their experience and their knowledge to learn, hey, how does this work, right? How does it work in the storage world of this side of things? And we found out all the systems that we need to have in place and things like that. And then sorry, and then to uh push our business plan, we actually walked in and said, okay, now here's the side that we do, right? We're going to push these rents. We're going to do this. We're going to do that. And we're going to have checks and balances in place because none of us were local to that property. So it really comes down to having those teams that you can count on. And when you can't count on somebody, you need to make sure you have somebody that you can hire that you can count on. Tickle in my throat today. And so that's kind of how that worked. And we felt very comfortable with the team for our first deal. I'm going to just going along the lines with the vetting people. We turned around maybe a year later. We bought another property in Texas so we could be the boots on the ground. We were about 4 hours away, but somebody else was still asset managing out of the three of us that were partners. And we stopped in to check on the property, and there was trash all over the place. There was an apartment on the grounds that nobody was supposed to be living in, and the person had moved stuff in there. There's video cameras on the grounds. Like, she should have known these things. We didn't have access to the videos. And so even though you've already done a deal with somebody, you feel comfortable with them, you still need to follow up and check on people along the way to make sure they're doing the things that they're supposed to do. We called that person, said, hey, you need to get out here and take care of this. And she basically refused. And so we stayed for the weekend. We took care of the problems and took care of the things that needed to be taken care of. And then had a meeting maybe a week later or so. We sent them a bill for our time because it was not part of our job to take care of those problems, the day-to-day issues. And then promptly came back with the partnership was looking to liquidate. And so that's when we sold our properties. So, and we did on that one, we owned it for 13 months and we got a 30% return in 13 months. So again, storage can be a very good way, but it doesn't always work out that way. We just happen to implement some multifamily things into it that made it work well for us. Let me see here.
I
The
think that
compatibility part, I'll just go into that one for a second. The integrity, it comes down to, questioning, asking questions. You can't, it's really tough to confirm those things other than questions and history and being around people. So you just need to be around those folks and get the information that you're looking for. Ask the right questions, and find them outside of events, right? Go meet them in person. Go have dinner with them. Sit down and really have conversations to see where people are at in business and in life. And then doing a background check. Like, anybody should feel comfortable with having a background check done on them. They're like $45 and you can get the information that you're looking for, to see where they really stand. So that's another possibility. And then the compatibility of partners, again, if you spend time with them outside of business, you can figure out whether or not you're compatible for business. Okay. I'm going to come back to this tough question that somebody asked. Um, and it says, explain the how and why of what a bank debt yield is. And I appreciate the question. What I will tell you guys is there is a website called investopedia.com that you can go in. And if you scroll to the bottom of that, I think it's on the main page. There is an alphabet that goes across. And if you click on it, it'll give you um, different definitions for different terms. Okay. So your yield, well, that was yield maintenance. I typed, I pulled up yield maintenance and defeasance as well, because those are oftentimes questions as well. But so the debt yield is another term for it. Can be yield to maturity. This is the internal rate of return that equates all future cash flows of a loan to its current price. So the yield the yield assumes that the bond is being held, or the note is being held until the maturity date, and that an investor can reinvest at the same yield rate. That's the basic conversation, but how does that equate to yield, to the debt yield on your loan? Um, what I'm going to tell you is that it can fluctuate uh, between whatever the rate is that you are uh, getting the initial loan for, and when you sell it back or when you pay it off, right? As the interest rates rise during the hold period, the yield is higher. If interest rates fall and go lower than the interest rate that you came in at, it goes down. But no matter what, there's still that factor of, okay, here's how much money the bank intended to make on the note. Over the course of 5 years, they have a debt yield of 8%. They expected to have an average of 8%. Excuse me, a debt yield minimum of 8%. And so they were going to make 8% on their money. If they have not met that version, or that amount, I guess, that's when um, you would owe additional funds. So if you're paying back the bank, the yield is estimated total return you get from the loan itself if you hold it until maturity, right? So if it was a 6% interest rate, 6 times 5 is 30%. They would expect a total of 30% on their money over that time frame. Let me see here.
Can I can I explain it the way I understand it? I like to. I don't want to break your thought though.
No, go ahead, because we're not talking about defeasance and we're not talking about yield maintenance at the moment. We're talking about something different. I just want to make sure that you realize that.
Yeah, so the way I understand it, and this is all like, think of the bank. The bank is funded by who? By investors. We actually met a bank owner in one of the conferences, but that's what they do. They go and raise capital from investors. So they have to perform a certain, or achieve certain projections for their own investors. So they turn around and lend the money to, let's say, lend the money to your project. Now, the type of lending we have, the long term, so the permanent debt, the long term agency debt, those loans, they want to put them in a deal that works, and they want to stay there for 15, 20, the longest time. Okay, so they give you a certain percentage. Usually, it's lower than if you go for a bridge, but they're expected to make that money and the amount of time that you have the money borrow, because they have to pay out their investors. So what happens if you decide to, I don't know, exit, sell, whatever? Now you have this debt that you're gonna turn around and pay it. That all looks good. However, the bank still needs to perform for their investors. So they want to make that percentage, and that's what they charge you for early exits, for deficiencies, for there's all this built in. If you exit early, this is what I'm going to charge you. If you don't, then we're all happy. You get your interest rate at this rate. There's also a floor, what's called a floor. Like that's how low they can go. Sounds like a song, right? But that's another terminology for that you hear sometimes. Like this is your interest, and we have a variable, and this is the floor. Like so, when you go to a real deal, when you actually have a deal and you are given a term sheet, and it usually has five, six options, and then you are going to compare, you're going to take that information, you're going to plug it into your underwriting, and then based on what you see, for the returns, you're going to then make a decision, or you're going to make an educated decision, educated decision to say, if I go with this lending, then it kind of goes with my business plan, or I shape my business plan, to meet this lending. Then it kind of like it's almost like when you're landing the plane, you're also ready to take off. So meaning that you're like maybe refinancing or maybe exiting or selling the deal at this many years because financially it makes sense. So again, I guess it's difficult to like give you specific um examples when you don't have a deal. But when you have a deal, I guarantee you. And in fact, I think I have a chart that I built to show you like this type of debt. Usually, they ask you for this liquidity. They want the net worth here. What are the average rates? I think I put that together maybe 2 years ago, so I will have to update it. But because the interest rate has changed so much. But when you see it all together, it's very helpful. I hope that gave you more clarity and we didn't end up putting you in.
I think no, I think in some ways that you were describing something different, because the debt yield shows the lender's expectations of
Expectations.
how potentially volatile the property is, or how much risk is involved. And in general, you will see a debt yield listed as somewhere between 8 and 10%. Anything above 10% would mean that it's considered very, very low risk. Anything below 8%, and it's got a little bit of risk. So they're looking for stronger sponsors. They're looking for stronger outside influence to potentially help the deal, perform better, if necessary. Right. That's the type of stuff that they want. So I did bring up a formula that basically says your loan amount is equal to your NOI divided by the debt yield. And let me just run a quick divided by point. That's off. Maybe I have wrong numbers in my mind. I was just trying to calculate one real quick and see how close it came in for where something was. But in the long run, in the long of it all, I guess I'll say is the lender sets these terms based off of what they see for risk. It is something that you can ask them to explain. It is just as confusing as what we just told you. And I will say the exact same thing about debt yield yield maintenance versus defeasance. The two of those are always a confusing conversation for folks. And what I tell folks is that basically one of them depends on what the interest rate is today versus how much they could make if they continue to stay in the debt. The other one is more or less just whatever they would have made had they stayed in the deal, and you have to pay it back, right? On either one of those. It's one or the other. I'm like, I don't remember which one's which specifically right now. Our preference on our debt service is to have an exit. So defeasance and yield maintenance are related to your exit fees. And so our preference is to do a step down. So it's a set interest rate, a percentage, not interest rate, but a percentage of payoff. So if you're 1 or 2 years from the maturity date, it's only 1%. If you're 2 to 3 years, it's 2%. 3 to 4 years, it's 4%. That type of thing. So it's called a step down. And depending on your term of your loan, so 5 year, 7 year, 10 year, can determine uh, when that shifts. So like the first 4 years, you may be at 5%. Anything after that, you might go down a little bit faster if it was a 10-year loan, or they'll do 2 years for each. Okay. So I hope that was helpful. Um, I will try to be better prepared for a debt service, debt yield question the next time.
Mhm. No, that's awesome.
That one.
I
How's your
think
LLP experience been? Do they generally deliver their expected returns? You want to hit that one real quick?
so. When we first started investing, we started investing passively. We invested in, I think, 8 or 9 deals passively. What I can say is that the market has definitely changed. We do have our portfolio, it's probably, I will say about what 60, 70%, 65% of it paying, and the rest of it is accumulating. What that means is that you can hear, I mean, when you're pitched a deal, you're given what's projected, like what is the expectation. Anything could happen. A black cat can walk in front of you and everything, all the projected numbers can go out the window. So how do we mitigate for that? The specific questions that they've been asked, like how do you choose your partners? When you are invested, even if you're investing passively, um, you're becoming a partner with that sponsor. So we want to know who is in the deal. What is the role for the deal? How well do you know the partners? We want to do the same due diligence as if we're doing the interview for a co-GP. How much money do they have in the deal? Because the stronger that we feel that we trust that information, that we trust their partnership, that we're going to be well represented, that the person that we are investing with or through is going to have a voice represented at the meeting or the table. That's what we're looking for. Now, the deal itself, there's so many things that can go well or bad. And this is what is so important. You need to do your vetting. You need to do, like, really understand if somebody's pitching you a deal, ask them discussions that we've been asked right now. How are your deals going? How many deals are you managing right now? What is your role in those real deals? How much money do you have in those deals? Like, that's the kind of questions we ask. Now, because now we are sponsors and we can take on a deal, so we don't really have a lot of opportunities to invest as passively. We invest like with our self-directed money. We invest in our people that we coach, because obviously if we coach you through an acquisition, we also want to invest in it, because for whatever reason, maybe we're not sponsoring with you, but we believe in the deal. We give you the right guidance, and we want to stay together with the deal. So and because we cannot invest or self-directed money into a deal that we have control of, so that's the perfect situation where we invest passively, but same thing. We are doing all the same questions. Like, we know the deal. We on the road the deal with them. We're probably, we like that because we're coaching them. So those are the kind of situations where we put our money as an LP. Now, how are they doing? Actually, the last one that we invested as an LP with a couple that we coached, they've been cash flowing just like we projected. We've been cash flowing every month. The money comes into the self-directed. As far as the how many GPs, I have to look at how many, because I know some of them fall off and some of them are being um under contract for sale. So I used to say 22, but I really lost count. So if you're listening to this and you're like, she said 22 last time, and I'm saying different number, let's just I don't know, Chris, if you have that information.
Of how many are we GP on?
Hmm.
Oh, I'll have to pull up the
I know,
SREO.
right?
I'll have to look. I don't know offhand. I think we've done 19 syndications.
And then
I think we've done
this
a total of 19 syndications, and then we have some joint ventures.
and this last acquisition is the 20th then? Anyway, more than
Yeah.
10 for sure. So I know it sounds a little ridiculous that you don't know exactly how many, but that's the
I Sorry, I remember when we first came into the syndication world, and somebody was like, "I don't know, I have somewhere around 2,500 doors," and we were like, "How do you lose how many doors you have?
right,
Like,
right?
how
How
do
do you
you
lose
do
one door?
that?" But seriously, if you're not talking about them every day, it's like, okay, there's some variation here and there. You pick up a new asset, you're like, wait, I was at 20, okay, yeah, add 32, add 35, whatever how many was it? Oh, it was 34. Okay, and um, you will get to this level. That's what
And
I
we
want to tell you.
want you to
It is
have this kind of
possible to get
problems.
to this level and have this problem because people ask us, "Hey, how many are you GP on?" Right? You're asking that, and what I can tell you is it's just under 1,900 doors. We are passive in about another thousand, right? Another thousand apartments. So we have all together, we have just under 3,000 apartments, just a little over 2,700, I think, is where it sits at today. And that's just apartments. That does not include our mobile home parks or the storage. Those are separate. We keep those numbers separate because people will talk about, like, if you ask somebody, how many doors are you in? Oh, I'm in 3,000 doors. All as a general partner? Well, no, actually, I'm in 2,850 passive, and I have 100 doors. Right. I have 100 doors that I own with some people I'm a GP on. So that's another piece of vetting your team is really dig into the questions a little bit. Same thing with checking on the integrity, right? How do they tell you that they're involved in these different projects when you don't dig in deeper? You know, that's just another piece to it. So
Remind me, thank you, Chris. Remind me, if you, I know I do have a list of 10 questions that we ask. That's like very, straightforward. So if you
mhm.
want that list of those 10 questions to ask a potential partner, just send me a text so I can be reminded. I'll send you the link so you can have it. Um, so good, good. Okay, I think we cover all those questions. What I want to talk about, I think because let me see. Because we were like, um, sorry, I lost track because I had. Did you move the questions to answer? Because I don't see it.
I did answer a bunch of them. Yeah.
Okay, I'm like, where is the? I saw the question and then it's gone. So sorry. See, that's how easy it is to lose track. To lose
Try to
track
make
of
it so
that.
you don't have to keep scrolling the questions.
Oh, this is what I was going to talk about because sometimes like because you don't know you don't if you're not there yet you don't even know to ask the question. One question that I like to answer even though it's not asked here but is very pertinent and it's also if that's where you're going, if you're looking to do a GP position or you're being more active and then eventually maybe like have your real estate income be more than what you can make in your business or your profession, your job, your W-2, whatever arrangement you have for income. Um, then you have to at one point understand this, and this is something that came up a couple times. It has come up usually when it's the first GP position. um you get K1s as a partner, and the syndication or a joint venture you get K1s. So when you are invested, and this came from because we were like totaling all the doors that we have. My point was that we are invested in all of those deals, whether we are invested passively or we are the ones running the deal that we are sponsoring. We are invested, our money is invested along our partners. And that's one of the things that I think I mentioned earlier. We want all of our partners to have their own money in the deal because, it's, I'll say it's easier to not care, or maybe you fall in love with the deal and then you're like you got busy and you're like, I don't have a lot of money there, and you just start disconnecting. So we don't want that because of we want to make sure that everybody stays in the deal, pertinent to the deal, attentive to the deal, with a priority to the deal. Even though we're looking for other deals constantly, The deals that we have under already purchase, that is our priority. If something was to happen in any of our deals right now, we will not, like, not fully, because we have our team now, and they continue to do with with the search for deals, but we wouldn't be like visiting properties. We wouldn't be like talking to really anybody. Like, we might cancel this if something really goes into from our portfolio that needed our attention. And it's two of us, even if one of us will be here conducting operations in the business. So anyway, so we are committed to the deals. Okay. So I wanted to make sure that I mentioned that, because it's easy sometimes when you're like, well, how much money do you have? And you're asking, let's say that you're asking the minimum investment to be $50,000, and then you're like, well, I have 10,000 I left in the deal. Like, how is that even fair? You're asking somebody to invest 50 and you're leaving 10,000, like it. That's been something that, I get it. It's hard for some people. They have the time, they have the desire, they're so enthusiastic. They don't have money. You're gonna have to have some money to get started. Yeah, I don't care. Like, I feel that's the ethical thing to do, and I know that's what we do. And then the other question, the other topic I wanted to cover quickly, because I know we're coming to the end. When you get your K1s, you get a different K1. You get two K1s. And I know I recorded some of this information where I actually share the K1s. I show you what do you make with your equity that has no money in, and what do you make, and income and depreciation with your money that is left behind. So I say that because our money is working in those deals, but we are also growing our net worth because we share the equity. And that's what being a general partner means. So I wish for all of you to that be your goal. If you want to run your deals eventually by yourself, then go at it. But my goal for you all is that you can be in a position where not only your hard-earned money is working for you, but you're earning because all the sweat equity, all the work that you're doing. And that's like, you pretty much, your babies are having babies and they're all working for you. And that's what it's like when you are in a GB position. All right, I think we have one more question. Um, uh, yes, we do have a form that you can complete. Yes, I will send you the link. If you can send me a message. The question was, do you have a form, or how do you intake a potential deal? We do have that form, so let me just text me and I will send you the intake form. Um, All right. Well, time flies when you're having fun. Thank you so much for the questions. I love entertaining questions when you guys are here. I think it's only fair that, because we get a lot of questions. I know that we get some questions offline and I know you're here and you're like, well, didn't get my question answered, because we give priority to the people that is here. We do have to travel tonight. That's why we're keeping it to strictly an hour. And we have 4 crews working the property, so I need to go take care of them and make sure we have everything ready for exiting this property. But if you're in Houston, we're here for a couple more days, and I would love to give you a tour to the property. We'll show you what we did, how we bought it, how much we put in, and capex, and the impact and rent increases. So we'd love to meet you in person, or if you're willing to travel here. Like, again, we're gonna be here for the next 3 or 4 days. So please reach out, Houston, Texas. All right, guys. Chris, anything else you want to add? You are muted. You're not adding anything.
I know, right? We appreciate you guys coming out. We definitely appreciate the support. And yes, we would love to see the deals. Like Maricel said, before you go to LOI. And really, it's nice if you can do it before you have the pricing conversation with the broker, even, because it looks bad when you have to take million and a half off of what you were offering. The only other extra nugget that I'll throw out there, because a lot of people question this, is that right now is a great time to buy apartments and other assets. But with apartments, if you're within 30% of their asking price, you're probably in the ballpark of what the real value is. All right. So I just wanted to throw that one last little nugget before we get off, so that you, as you're evaluating deals, you can take a look and know that you have a pretty good shot at what you're thinking is a decent deal, as to whether or not it really is.
Thank you, Chris. I'm gonna use that information to go look at my 44 deal, my 44 units and my 25. I know it's cash flowing. It has to cash flow. And anyway, guys, see, this is our day. This is our every day. You learn something, you implement, you go at it, you talk to the broker, you go visit the property. Again, if you're in Houston, let's go look for some properties. All right.
I
Thank you so
love it.
much, Chris. Thank you guys for being
Yep.
here. I can see the commitment. I love the hearts too. Bye, guys.
Thanks, guys.